Hey everyone, Douglas here, and tonight I want to discuss the market that we have found ourselves in the last 16 months. It seems to be an infinite bull market, and I want to discuss what I think is really one of the key driving forces of that bull market, and maybe something to look at to indicate if it might be rolling over soon. So if you are new here and you like what I'm doing, make sure you hit that subscribe button. Turn that notification bell on as well so you won't miss any updates. And if you find this video particularly helpful, make sure you give it a thumbs up as well. It really helps that YouTube algorithm out, and I would appreciate it. One final thing, too, before we get rolling with the kind of the meat of this video. I've been seeing a lot of good growth on the channel recently. It encourages me to get on and do more stuff like this, more updates like this. And one thing I've been thinking about doing, especially as I approach 2,000, maybe for a special 2,000 subscriber special, is start doing a few live streams. So if that's something that would interest you, let me know in the comment section below, particularly any topics that would interest you for a live stream. Let me know, and yeah, maybe that's something we can get off the ground and put together and have some fun with. So yeah, let me know what your thoughts are in the comment section. Anyway, let's get on to the topic at hand tonight, and that is the bull market that we have seen. Just to put this in perspective, before we kind of get into the data portion of it, if we take from the lows back on March 23rd of 2020 to where we're at today, we are at nearly 100% run up again from those lows on March 23rd to the recent high that we made today. So 100% in 16 months. 491 days here on TradingView. To put that in perspective, if I scroll on out and move on back to the sell-off after the Great Financial Crisis and see how long it took to get a 100% move, you'd have to go over 2 years to get a 100% move from the 2009 lows to the final burst above, momentary shot above 100% in April of 2011. So the rise that we've seen in terms of 100% move is quite unprecedented, and the question you kind of got to ask yourself is what's been the main driving force of this. And if you're new to this channel, you might not be aware of my love of MMT, but if you've been around, you'll know that I likely have an MMT explanation for it, and you'd be absolutely right. I think the best way to put this is the main driving force in terms of higher equity prices, in terms of an expanding financial sector as a whole, is new money coming into that financial sector. Okay, at the end of the day, when new money comes into the financial sector, that new money is either going to be saved or it's going to be spent. You can't do anything else with your money other than save or spend it. Whether you're a business, whether you're an individual, it's all saved or spent. And if it's saved, that's money entering into the financial economy, and some of that money finds its way being saved into stocks. If money is spent, that means that money that's being spent, so let's say you get a stimulus check or whatever it might have been, and you buy whatever it is that you want, a TV, a cheeseburger, whatever, those are profits of companies, and that pushes profits higher when there's more money entering into the economy or entering into the financial sector, which will also prop up equity prices as well. So at the most fundamental level, and this is through the lens of MMT, modern monetary theory, at the most fundamental level, that new money coming into the economy is going to support an overall higher equity price. All right, and if you've followed me for any amount of time, you're on my Patreon feed, this is very well spelled out, not only theoretically but in the data as well. And so what I want to look at tonight is how I calculate the fiscal flows, which is kind of the core of at least the foundation of where I build all my analysis from, and I think is the true primary factor for why we've seen the run up that we've seen. And then we'll kind of get into a few more details and some ideas and kind of take it a little bit deeper. So what I'm bringing up on the screen right now is what I call the net fiscal flows. This is one of the things I calculate on a weekly basis. This information comes directly from the Treasury, and yeah, I track it, and I've found probably the best way, or at least the way I like to look at it, is most helpful for me. And what this is the yearly average of the net fiscal flows the yearly average of what new money is coming into the economy at each day, essentially of the past year average, so moving average for the last year. Okay, and why this is helpful is it can show you kind of visually, essentially what the deficit is going to be for that year, right? Or, what the growth of the national debt is. And again, as I just explained, a larger national debt means more money in the financial sector. A contracting national debt means money is being taken out of the financial sector. So this is going to be really important to look at when you're trying to get a grasp of, how much money is out there to play with in the economy, for the economy to do what it needs to do. And those two functions, the two most important functions, are, again, money that is going into savings that's finding its way into equities, and then money that's being spent that's on businesses and profits being pushed higher, and therefore valuations pushed higher as well. And so that is what we're trying to understand when we look at this data and try and make some estimations from that. From the data in terms of where, what the market might be seeing. So to try and, explain what it is exactly you're seeing on this, again, I laid out exactly what the data is here. And so just to kind of show you, currently right now, we are just slightly above the 10,000 line here, and this is in millions of dollars. So $10 billion on average over the a yearly moving average is being spent into the economy right now every single day by the U.S. federal government, essentially. Right now, the majority of this is some of the benefits that have come post COVID. You can obviously see the COVID takeoff here back in 2020, and we've certainly been seeing some of that wane now that the stimulus checks are done and some of the unemployment benefits are coming to an end. And certainly we'll see it wane some more when unemployment benefits come to a complete end. But these levels are, I don't have to spell it out, clearly unprecedented. To put it in perspective, the closest we've been to a recession, short of the COVID recession, was heading into late 2015. And you can see back in late 2015, we had slowly but surely diminished in terms of the new money coming into the economy up until that point, right? And it's when you get to those low levels, so we're looking at $2 billion new dollars a day coming into the economy, when we get to those low levels, that might not fulfill the appetite for what the financial sector needs in terms of new money. And you can see heading into the great financial crisis, we were darn near zero, right? So the economy at that point was solely reliant on the financial sector to create the loans to meet the need of the economy for its desire to spend. Okay, and that's really what this breaks down to. And so this, to me, these fiscal flows are the true key to what has been driving the move up. And I know a lot of people say, well, yeah, it's obvious if the government spends, you're going to have stimulus, but I don't think people have the full framework, and they definitely don't understand that this is truly a net benefit to anyone who's receiving it, and that net benefit ends up in the financial economy. Or ends up propping up the financial economy, pushing forward. So, I mean, this is really the bread and butter of what I'm looking at on a week to week basis. Now, granted, there are many other layers to this that need to be understood, especially depending on your trading strategy. But if you're a buy and hold sort of person, and you're literally looking to simply dodge things like the Great Financial Crisis or 2000 drawdowns that are extended not only in price but time, I mean, this is a great starting point to understand that as long as we have strong fiscal flows, the likelihood of a major recession occurring is very slim. And even if we do get a recession, it would be relatively short-lived in an environment where we have relatively long fiscal flows, because the banking system, when it deleverages, it will quickly have the necessary kind of ammunition right behind it to go ahead and kind of refill the coffers, if you will, and re-leverage up and go through the next business cycle. So one of the things I do is pay close attention to the fiscal flows. And again, if it's something that's interests you, check out my Patreon page over at patreon.com/CanonMA. This is data we follow on a week-to-week basis, and yeah, it builds the core of my entire analysis. So what's next then? Well, we've like I said, we've seen the big drop off in terms of net fiscal flows, but yet we're still if we stay at these levels, we will have sufficient fiscal flows for a relatively strong financial economy, a big caveat there, financial economy for many, many years to come. The question is going to be, what is the business cycle looking like, right? So that'd be another layer of analysis. What is the business cycle looking like? And then also, what are just kind of the market dynamics looking like? I made the video recently on GEX, and these things can really, if the timing's right, these things can really perpetuate selling that might have been relatively neutral or modest, and so there are definitely, again, varying dynamics. But as long as fiscal flows are as high as they are right now, we could see a continued run for quite some time. And even if they begin to diminish, again, this is new money being added, so not until we go below the zero line would we actually be in a territory where we're in a government surplus, where money is actually being taken out of the economy. And certainly something like that could develop relatively quickly, given the right policy changes, higher taxes, something like that. We could see this whole trend very quickly change pace. But at this point, it's not. And I think the big hurdle that we're going to need to get through is what happens when the unemployment benefits go away, and then what sort of stimulus package happens after that. What sort of infrastructure package happens after that? Those are the questions that need to be answered, and will definitely give us a clue as to where we are headed. To go and wrap things up, I make this video saying, that the main driver of the rally that we've been on is these fiscal flows, and I expect them to continue. But I do want to make it very clear. Like I said, there are many things, particularly some of the operations that the Federal Reserve put in place following the COVID financial crash, that have also helped. As it turns out, the massive fiscal flows can actually be a double-edged sword. If the banks don't have enough capacity to take on that new money in reserves, they can actually get crammed up, essentially, right? And so you've heard a lot about reverse repo and that sort of thing, where the Fed is kind of aware of this issue and trying to facilitate banks' balance sheet capacity to go ahead and take some of that off the books. So that's important, and the Fed is doing a handful of other things that have helped banks not get overwhelmed. And as it turns out, on Wednesday, the Federal Reserve is going to have their monthly meeting, and some of the stuff might be discussed. So I could easily see some of the things that have benefited, not just only the fiscal flows, but also some of the other supportive structures might be getting a different look starting Wednesday. So we could see some choppiness as kind of the now truly post-COVID new normal, all that sort of stuff is finally coming into focus. Things could be a little up for grab going into the immediate future, and we could be seeing some choppiness. But I would say that if we do end up seeing some sort of sell-off emerging into the latter half of the summer here, that based on the fiscal flows alone, I would see that as a buying opportunity, and not an absolute end of the bull run at this point. So I think I'm going to wrap things up there. And if you have any questions on what I went over, by all means, let me know below, and hopefully I can square that away for you. Otherwise, I'm going to wrap it up. If you like what I'm doing here, and you're an active trader, active investor, make sure you check out that Patreon page, patreon.com/CanonMA. Well, I only get maybe an update once or twice a week posted on the YouTube channel. I'm posting multiple times a week on the Patreon page, and all my trades are public there, and we go into a lot more detail in terms of how to view things from an MMT perspective. So with that note, I will wrap it up. Good trading, everyone, and we'll talk to you next time. Bye-bye.